All right, guys. So fundamental analysis has to do with, analysis basically has to do with the study of the financial markets to determine when to buy, when to sell, when to enter a trade, and when to exit a trade and all of that. That's what analysis is all about. Okay. Now, when we come into the market, we want to be able to determine, we want to be able to determine where our trade should be. We can't just enter a trade randomly. So we do this ahead of time, basically studying ahead and looking into the market to see where the opportunities in the markets are, right? That's a concept of analysis. We have different types of analysis. We have the technical analysis, we have fundamental analysis, we have sentiment analysis, right? All of this we're going to be talking about, but today is for fundamental analysis. So fundamental analysis therefore has to do with the study of the fundamental factors that affect the market, the fundamental factors, the study of the fundamental factors that affect the market. Okay, so when we talk about fundamental factors, what do we mean? We are talking of the real life things, the real life situations, the real life conditions that affect the market, right? Now let's use currencies as an example. Let's pick currencies as an example. Now, we know something about currencies. Currencies represent countries. So if we look at the US dollar represents the US economy. The Japanese yen represents the Japanese economy, while the Great Britain pound represents the UK economy. Just like that, all across the world, we have currencies and we have countries. Now, whenever the country is doing well politically and economically, things are booming, there's stability in the polity, the economy is stable, there's economic growth, the currency of that country tends to appreciate. The currency tends to firm, tends to appreciate. That's for currencies. Okay. Now, those are the fundamental factors that affect the currency of the country, the economy of the country. So basically, whatever affects the economy of the country or affects the polity of the country affects the currency. So, but you as a trader, you might be looking at this currency and all you are seeing is USD or JPY and all that. You are just seeing a currency. You know, when you're on the chart, when you're on the chart in the market, you see all kinds of movement happening, But what is it that's driving those movements? What is it that's driving that movement? You see, so that's what we call the fundamental factors. For example, gold is a commodity. Okay, gold is a commodity. We spoke about all of this in a previous class. Now, gold is a commodity. Now, what is it that affects fundamentally? What is it that affects the value of gold? What is it that affects? Why is it that the prices of gold tends to appreciate under certain circumstances and then tends to depreciate under certain circumstances? What are the things? So like I said, when you come into the market and you see all kinds of movements up and down, you tend to look at those movements in the market in isolation. But nothing is isolated because there is something driving that asset fundamentally. An example is this. Gold is what we call a safe haven instrument or a safe haven asset, meaning that whenever there is uncertainty in the world, whenever there's uncertainty in the world, there is uncertainty in the global economy, uncertainty in terms of COVID, like what happened during COVID-19, what happened with the Russia-Ukraine crisis, which unfortunately is still going on. What happened when Hamas attacked Israel? All of those circumstances, whenever those situations happen, gold tends to be the beneficiary. Why? Because gold is known as a safe haven investment. Because investors think their perception of gold is that gold is not something you can destroy. If you put it in fire, it stays, But if you invest in a company, or a stock, the stock of a company, let's say the stock of that company is a mining company somewhere in Africa or somewhere in Asia or something, and then there's an earthquake in that place and the whole mine is destroyed. What happens? what happens to the stock of the company? The stock of the company is going to definitely drop. It might even drop to zero because the asset that makes the company money has just been destroyed. So that's the reason why stocks, for example, are called risk assets. They are called risk assets, right? Now, but gold is a safe haven asset. Whatever happens, you can't destroy gold. You can't burn gold in fire and then it's bad. You cannot. But if you burn a lot of things in fire, several other things, if you put fire into a house, the house gets burnt. The building gets destroyed. But if you put gold in fire, it doesn't get burnt. It doesn't get bad. So gold is seen, and with the pedigree of gold for the past centuries and all that, investors have confidence in gold. So whenever there's something happening in the world that is not palatable, investors go put their money into gold. Now, that is a fundamental event, a fundamental situation that affects gold. But whenever there is stability in the world, there's no special events happening in the world, gold tends to appreciate, depreciate. Basically, there is no clear, there is no, you won't see a significant movement in gold, right? Even if you see a significant movement in gold, it will be very short-term and short-lived and very temporary. But if you want to see gold buying very crazy, you want to see 10,000, 15,000 pips on gold, something must have happened. That's the reason why that during times like COVID, you go to the gold chart, you will see that gold attained all-time highs. Gold attains all-time highs whenever there's a problem in the world. See, these are some of the things we call fundamental factors. Fundamental factors, right? Okay, so let's proceed. Now, fundamental factors, fundamental analysis seeks to understand the socio-economic factors causing supply and demand imbalance. So what's supply and demand imbalance? Now, whenever there's a huge demand for anything, the price tends to rise. Whenever there's a huge supply of any commodity or anything, the price tends to fall. So when demand is high and supply remains constant, prices rise. Whenever there's a huge supply and demand remains the same, price tends to fall. You see? So now that's what we call demand and supply imbalance. Now, this is what happens with whatever business, whatever deal, whatever investment you're doing. Supply and demand is a way that the world works. It works in every single thing. You see? So that's what we mean by supply and demand imbalance. So when price is about to buy, there's a demand and supply imbalance. When price is falling, there's a demand and supply imbalance as well. So if there is no demand and supply imbalance, price will not change. If there is no demand and supply imbalance, price will not change. If you buy something for $10 and then for some reason nobody is willing to buy that thing for $11 or something higher than $10, nobody is willing to buy it for that amount, the price cannot rise, right? So you are not willing to sell it for less than $10. No one else is willing to buy it for more than that. So the price doesn't change. Nothing happens. But you are not under pressure to sell. Somebody else is not under pressure to buy. What happens? There is no demand and supply imbalance. That thing is not needed so much. You are not under pressure to sell it. The other person is not under pressure to buy it. What happens? There is no demand and supply imbalance, so price cannot change. See? So that's what we mean by that. Now, there are some themes that usually defines the world. Now, probably a few years ago, like 2-3 years ago or so, there were certain things. Donald Trump was the president of the United States at that time. Donald Trump's presidency was considered by many people as very chaotic because Donald Trump was not a traditional politician. So to a very large extent, he didn't understand a lot of diplomacy, how you resolve matters by sitting across the table. He would threaten, North Korean president and say, I will destroy your country and all of those things, right? Now he's talking to people who are not also very sane, So a president that understands the diplomacy, a typical politician will find ways to solve the problem, to resolve the issue. So that's why a lot of people consider Trump's presidency as a threat, a certain threat of its own in the world at that time, right? So yes, so these are some of the things that happened around 2020. We had Trump had, Trump's presidency, the situation it was. Then we had COVID-19. We had a lot of trade wars, America and China, and all that. Why? Then also a few years before that, also we had Brexit. Brexit is the referendum that happened in the UK in 2016, June 2016, when the UK voted, to leave the European Union, the European area. They decided to leave the European Union so that they can be on their own. They were part of the Eurozone before. So they decided that they don't want to be part of the Eurozone anymore because they considered that they were better than everybody else. And they decided, okay, we don't want to just open our doors for everybody to come work in the UK, acquire, once you get the passport, the European Union area passport, you can come into the UK. And we don't want that. We want to be able to put restrictions as to what to do or what not to do, so they did a referendum. The referendum is some sort of an election, to decide what we want going forward. How do we want to govern ourselves? How do we want to be perceived and seen? That's a referendum. And then some people voted, oh, we want to leave the Eurozone. Some voted we'd rather stay. Those who voted to leave were more than those who voted to stay. And that caused a serious, effect in the market, had a serious effect in the market. Now, when you look at all these things I'm mentioning right here, during COVID-19, a lot of things happened to the oil market. When I mentioned Trump would come today and tweet. Trump would make a tweet today, the market will start to sell or the market will start to buy. So all of these were affecting the market at the time. The price of oil went to negative territory during COVID-19 because demand for oil went to zero. Because when you have lockdowns in the developed countries of the world, America, the UK, Europe, all over Europe, China, then who's going to buy the oil? Oil fell to negative territory during COVID. Then Brexit too, OPEC. You have all the issues with OPEC deciding what oil to cut, what the number of production per day, the number of barrels per day to cut or to increase, and all of that. Basically trying to manipulate oil price. That's COVID. Sorry, that's OPEC. Then you have earnings. Earnings have to do with companies. Now we know that one of the instruments that we trade in the market is stocks of companies, right? Now, what affects the stocks of company? Why would a stock appreciate? Why will a stock depreciate? Today, Apple is an almost a $3 trillion company. Microsoft is almost a $3 trillion company. So now the question is, what is it that drives the stock of these companies? There's a company called NVIDIA. NVIDIA is worth over $1.4 trillion now. But why? What happened with NVIDIA? Why are they so valuable now? They are so valuable now because in 2023, they began to really, talk about their preparation for the AI world. The world began to see that, oh, NVIDIA is such a good company. NVIDIA is such a company that is very well positioned, to take advantage of the AI revolution that we are seeing right now. So investors started to buy more. They started to hold more. They started to, put more money into NVIDIA because they can see, hey, in the next few years, this is what AI is going to be. AI is going to be big. AI is going to be big. And with ChatGPT and the rest of them, that's how NVIDIA started taking off. That's what we call earnings. That's what we call, financial projections and all that. What is it that is going to happen? What is it that's affecting this company fundamentally? Why is it getting more valuable and valuable and valuable? You see? So usually investors price in the future potential of a company into the stock of that company. So if the stock price of a company is $2 today, but you can really look at this company, look at what they are doing, look at their future based on the current products that they have, the current management they have, the current vision that they have, and you can see that this company is going to be worth much, much more than this tomorrow. You can spend a lot of money today, you buy the stock, and then in another 2, 3, 4, 5 years, that stock is worth $200. You bought it at $10 now, it's worth $200, or $2 is worth $200. Now, why is it so valuable? Because of the fundamental factors, which is the company itself. what products it manufactures, what vision it has, what capacity is developing to be able to take advantage of a certain opportunity that's presenting itself in the future. You see? So then we have EU politics. Now, fundamental events could make a stock, a currency, or a commodity go stronger or weaker. So when you look at a country like a few months ago, several months ago, there was an earthquake, a very serious earthquake in Turkey. Very serious earthquake in Turkey, right? So when you see an earthquake that killed over 5,000 people, what do you think is going to happen to the stock of that, to the currency of that country? Definitely the currency is going to depreciate, because whenever something like that to that magnitude happens, that country, it's definitely bad news for that country. The economy is affected. A whole lot of things will happen. In some cases, the leadership of the government of the day will be called into question. Some people capitalize on that to question the capacity of the leadership of the day. The country becomes sort of unstable in that moment. Therefore, the currency itself will be affected, you see, negatively. So this is what happened in 2016 with Brexit, the Brexit I mentioned earlier. So Brexit was a political event called a referendum. It was a political event, a referendum that held on the 23rd of June 2016 to decide whether they want to remain in the UK or not. So investors had a perception of this event. They felt that for the UK to remain in the Eurozone was a good thing. But definitely some people, especially UK citizens and all that, some UK citizens felt that they did not want to be the ones subsidizing everybody. They felt they were subsidizing everybody in the Eurozone. So we don't want to subsidize anybody anymore. We want to let them go. We want to be on our own. And those were the guys that came out and voted for them to leave the EU. Now look at this black candle right here. This was where price was 1.50 something. This is GBP USD on the daily chart. This was where price was in 2016, just before the referendum happened. And immediately after the referendum happened, this is an election. You say, oh, what's the connection between an election and the market? Obviously there is. Now look at this. Price collapsed from there. Up till today, the UK, the GBP USD, which is the Great Britain pound, has not recovered from this move, this crash that happened 2016. So the currency, Great Britain pound, GBP, is weaker today than it was in 2016, by far weaker today than it was in 2016. Something significant has to happen for the UK for the currency to come back to where it was in 2016. You see? So yes, this is what we mean by fundamental events. So a good economy equals higher currency value. A good economy equals higher currency value. A good economy equals higher currency value. A bad economy equals lower currency value. So this is how you analyze an event. So we'll proceed, we'll get into some economic calendar right now to see where do we find these events that we're talking about. So every day, every month, every year, there are economic events that affect different countries, different economies, that therefore has an effect on their currency. So if an event is affecting the dollar, if an event is affecting the US economy, if there's some fundamental event that is going to come out of the US economy, therefore that event, if it's positive, is going to affect the USD positively. If it's negative, it's going to affect the USD negatively. So that's why we say good economy equals higher currency value. So if the economy is good, the polity is stable, the value of the currency will continue to appreciate. But if the economy is bad, the economy is weak, there's issues with politics, the politics there's issue with governance. Those in power are basically misappropriating the place, basically misappropriating everything there. There is no way that economy can be a good economy. And therefore the currency will be weak, very weak. Now we have such countries around the world. You have lots of them in Africa. You have countries like Venezuela, like Nigeria, like Zimbabwe, and all of those countries that have very bad leadership. And then you find those countries and their currency, the situation with the economy is visible within their currency. When you look at the currency, you can see, oh, something is not well, something is not working well, because you can see the currency is very weak and keeps getting weaker. So we have what we call the economic calendar. So the economic calendar is basically a calendar that lists all the fundamental events that are going to affect the market, that will affect in different currencies, different countries, the economic events that will affect different economies, and therefore, and subsequently, and consequently, sorry, the currencies of those countries, right? So now there are several websites where you can go and see some of these things. Most of the time you see them being reported all the time. You have CNN, you have Bloomberg, when you have investing.com, you have Reuters and all that. But Forex Factory is the #1 website that we go to find fundamental events that are likely to have an effect on the market, right? So when you go to forexfactory.com, you see a lot of things. So let's go there and check it out now. Forexfactory.com. So when you come to forexfactory.com, you see a lot of things. So this is a place, is an economic calendar. It's an economic calendar that shows you a whole lot of things. What is it that's going to happen tomorrow? What is going to happen? What economic event is scheduled for next week? How is that going to affect the financial market? And therefore, what am I going to do with that in the market? So what is the event? What is the fundamental event that's scheduled for next week? How is that going to affect the market? And how am I going to be able to make profit from that? That's the concept. What is it that's scheduled? Which currencies? What is the event, the fundamental event that is scheduled for next week? How is it going to affect what currency? What currency is it going to affect? Or what economy is it going to affect? How is that going to affect the currency? How am I going to make profit from that? You can't just be looking at things for the purpose of looking. As traders, when we come into the market or we have any information or any knowledge, we want to apply it to the market to make money. That's it. Okay, so that's what we see here. Now look at this economic calendar. So when you come to Forex Factory, you scroll a little bit, you come to the calendar itself. So for this calendar now, you see this week, January 7th to January 13th. Normally, when you come to this website, you will usually see the events for the day, for that particular day. Okay, you will see the events for that particular day. But when you click on more, you see more. When you click on more, it will give you the events for the next few days or maybe the next 1 week. And then also on this website, you will see all kinds of news. You can see all of these. A lot of these news are coming from Twitter, and all of that. So it's basically news events that are happening, analysis that's coming through the wires. This website is able to pick up a whole lot of them. Not all of them, but a whole lot of them. But the most important thing we're watching for here is not all the other news. The most important thing we'll watch for here is the economic calendar itself. The economic calendar itself and how we are going to use that to trade. So you can see now this is for this week. On Monday, we had a bank holiday in Japan. Then we had CPI for CHF. CPI is what we call Consumer Price Index. Okay, it's a measure of inflation, but we're going to look at some of that. Then you can see Tuesday we had nothing. See, that place is totally blank, meaning there was no economic event for Tuesday. Then on Wednesday, you see we had an event, an economic event that affected the AUD, the Australian economy, therefore the Australian dollar. So this is what we call CPI. CPI is also inflation for the inflation for the Australian economy. So you will see 3 numbers here. You will see 3 numbers in some cases. You see 2 numbers in some cases. But so what does it mean? Now you will see previous. Now some of these data, understand this. Some of this economic data you are seeing here, you can see the date, the time, the currency that it will be affected, the impact, and so on and so forth. And the event itself. What is this particular economic event? What is it about? See, that's what you find here, right? Now, when you look at these now, most of them, you will see that for Monday, you can see 3 numbers, 1, 2, 3. For Tuesday, there's nothing. For Wednesday, you can see 1, 2, 3. Today is Wednesday, but this happened 1 a.m., 1:30 a.m. So it has already passed. So what you will notice is that for events, for economic events that have already passed, you will see that there are 3 numbers, three numbers there. So there's the previous, there's the forecast, there's the actual. The 3 numbers will be complete. But for data points for like tomorrow, see, now this is Thursday. These are data for tomorrow and Friday. You will see that you do not have 3 numbers there. You actually have just 2 numbers. You have just 2 numbers. You don't have 3 numbers there, right? So now, what does that mean? Now, for all of these data points you see here, most of them are released once every month, because every month they are monitoring the environment, they're monitoring the economy, they are monitoring the economy to determine what is it that is working well. What is the problems that we have? What are the problems that we have? What is the challenges that we have? What is it that's working for us? What is it that's not working for us? And they put out this data to the marketplace. They give these data points to us. And then we as traders now use this economic data to determine what we should be buying and what we should be selling. We now use this information to make money in the market, to go into the market, to make money in the market. Yeah. You see? So that's what this is all about. So now for the ones that haven't been released like this, like for tomorrow and next, you notice 2 numbers. So you have the previous. Previous is the data for last month. Data for last month. So every month they release new data, but they compare it with last month. So as a trader, you are able to come to this calendar, you are able to determine, oh, the data for this month, was it better or worse than the one for last month? So that will tell you, oh, is the economy of this country, is it doing better this month than it did a month ago? Or is it doing worse than it did a month ago? And we know that if the economy is doing very well, the currency will appreciate. That means your currency will rise, which means that a buy opportunity will be very profitable. Now, if the economy is not doing well, it means that the currency will depreciate, right? It means the currency will depreciate. And once the currency depreciates, a sell opportunity will be very profitable for us to take. So you see, as traders, we don't even really care that much. Of course, we care because we are also in this world, but we don't. When it comes to trading, we really don't care where the market goes. We just don't really care where the market goes. It's a question of if the market is selling, we are able to get sell opportunities. If the market is buying, we're able to get buy opportunities. We can make money whether the market goes up or comes down, right? So now you notice this previous data. These are all data, previous data, previous. Now there is forecast. So what happens is that this number is what economists and analysts that work at very big banks like JP Morgan, Merrill Lynch, Bank of America, and all that, these economists, or even in companies like KPMG, like PwC and all that, economists that are in these very big companies, what they do, this is their job, this is part of their job though, every month, they use incoming data to determine what the economic data for the month might be. We know the one for last month. So, but the one for this month will be released tomorrow. For example, let's say, look at this now. You have USD core CPI. This is a data that will be released tomorrow, Thursday. So what these economists do, these analysts, what they do is they look at all the what's going on in the economy since last month. Since last month when the last data was released, they look at that and compare to what is happening currently just before the current economic data is released, and they are able to make a forecast. So it's more like it rained yesterday, something like that. It rained yesterday, and then you begin to monitor the clouds, like these meteorologists and the rest of them, and they have all these equipments they use to monitor the cloud, humidity, and a whole lot of other things, and they are able to tell you that, okay, it's likely to rain tomorrow. Now, the thing is that it may actually rain or it may actually not rain. They are just making forecasts. They are not God. They don't know the future, but they are just making forecasts. So that's exactly what these guys are also trying to do with economic data. So they look at it and they say, okay, let's make a forecast as to what is likely to happen at the next economic data release. Right? So look at this now. You have CPI, USD CPI year on year. Last month's data was 3.1%. So this is what inflation looks like in the US right now, 3.1%. Now, analysts are saying that in this new month, which is tomorrow, in this new data that will be released, which is tomorrow, right? The data is going to be inflation is going to be at 3.2%. CPI is going to be at 3.2% from 3.1% last month. Now, like I said, it does not mean that this is what's going to happen. It may actually happen like this. It may actually not happen like this at all. So, but we make sure that we are watching this so we can have an idea. Because the truth is, the market sometimes is a self-fulfilling prophecy. The market a lot of times is a self-fulfilling prophecy. So if a lot of us think that, oh, the market is going to sell, the likelihood is that it will sell. If big money, a whole lot of people with a lot of money believe that, oh, the market should be rising based on this data, there is a tendency the market will do that. Why? Because if everybody thinks that the market should rise, what are we all going to be doing? We are going to be buying. That's demand. So we buy when we expect the price to rise. So if we all think that the market is going to rise and we all start buying, then of course we are the ones making it happen. We are the ones making the buy, the appreciation we're expecting. We are literally making it happen. You see? So that's the way the market works in many cases. So it's good for us also to have an idea. What is it that's likely to happen in the next economic data release? That's what this is all about, right? Now, when it says actual is the data itself when it's actually then released. Now, by 2 p.m., 2:30 p.m. tomorrow, Thursday, January 11th, this data for CPI will be released by 2:30. This is GMT +1. This is Nigerian time, right? So that data will be released. Then as traders will now be able to take that number, that data, compare it with the forecast and compare it with the previous. We compare it with the previous, we compare it with the forecast. And then we will now be able to determine, oh, is this good for the economy or is it bad? If it's good for the economy, that means we are going to be buying. If it is good for the USD, that means any currency that has to do with USD, we are going to be buying it. We are going to be buying that currency in favor of the USD. We are going to be trading any currency that we trade, we are going to be trading it in favor of the USD. Now, it may be buy, it may be sell, depending on which currency pair we are dealing with here, but we are definitely going to be trading in favor of the USD. So if we have a currency like USD JPY, we will buy. If we have a currency like Euro USD, we will sell. Why? If USD is the base currency. So if you're buying USD JPY, it means that if this economic data is very good, you should be buying the currency that has USD as base currency, just like USD JPY. In USD JPY, USD is the base currency. In Euro USD, USD is the quote currency. So when you are buying USD JPY, you will be selling Euro USD or gold or XAU USD, right? Yeah. So a few more things here before we proceed. Now, you notice here under impact, you can see some colors there, and also detail. When you come to this website and you want to be able to see what is it that all these events are all about. What is all these events? What are they all about? This is what you find under detail. Okay. When you click on detail, it will show you. It tells you the source, Bureau of Labor Statistics. So it tells you even how to trade this event. You find it here. You find it how to trade this event. It tells you what is here, what is about. Consumer prices affect the majority of overall inflation. Inflation is important. So it's telling you what this is all about. You see, so you can come here and you can know exactly what it's all about, right? Okay. So let me do something and show you guys this. Okay, so now you can see that there are different, we were seeing only red colors the other time, but now you can see there are other colors there. right? So let's look at the other colors and see what they're about. So you see, the first one is ash. It tells you is non-economic. Non-economic means that that particular currency, that particular event, economic event, is a holiday. Is a holiday. So it really doesn't affect the market like that. But the reason why we usually watch that as well is because whenever there's a huge holiday, whenever there's a holiday in a major economy like the US, in Japan, the UK, and the biggest economies in the world, liquidity in the market tends to shrink because a lot of the big traders are in the banks. They are banks. So whenever their doors are closed, whenever there's a bank holiday, you know, remember a bank holiday, not just any holiday. Whenever there's a bank holiday, banks will be closed. And when banks are closed, volume in the market will tend to shrink. And when volume in the market tends to shrink, it becomes possible for some bad actors to basically manipulate some markets, not all markets, but some markets, right? So that's also why we keep an eye on bank holidays for major economies, because on those days you can just decide, you know what, today the UK, the US have holiday, I'm not going to trade. Today, the US and UK, there's holiday in the US and UK, which are the two biggest economies when it comes to trading in Forex. I would rather just wait till tomorrow. I'd rather just stay away from the market today. And that could be a good thing. Okay, so the next color is low impact. So anywhere you see, when you come on your chart, anywhere you see yellow, you know that that's an event that is not likely to move the market. It has no effect on the market. So you just skip it. All right, now let's come to this one. You see, there's another one here. This is orange or brown. It says medium impact expected. So what that means also is that that one does not have an effect on the market. So any event that does not have an effect from the market based on the color, based on the impact. So this color is telling you what impact it has. Is it a high impact? Is it a low impact? Is it a medium impact? So if it's a low impact or is a medium impact, it tells you that the market is unaffected. It tells you that the market is unaffected. So if the market is unaffected, then you also need not be bothered about that event, right? Then you have the red folder. The red folder is high impact expected. High impact expected, that's what you are looking for. So whenever you see an event that is in red folder, it tells you, oh, this is important. I should pay attention to this. This is important. I should pay attention to this, right? So that's the one you are going to be looking to pay attention to. Notice when it comes out, know when it will come, that event will come out, and then you make sure you protect yourself from that event if you are already in a trade, or you want to take advantage to trade that particular event. It's fine, whichever one you decide. But the only thing that you have to do, what you must do is that you must keep an eye on high impact events if you are a trader. If you're not a trader, it's fine. But if you are a trader, which all of us here are, we need to keep our eyes on high impact events. Okay, so now since I'm only going to be watching for high impact events, there is no need for me to allow my page to look like this with all these other irrelevant events. Most of them are irrelevant. So what's the point of me watching them and waiting to see them? There's no need. So what I do is I do what I call filter. What we call filter. You see, filter. We click on filter. We know that low impact event is not useful, so we remove that. We know that medium impact is not useful, we remove that. So we can keep this bank holiday folder. We can keep this one just to know when there is a bank holiday, right? And then we keep the red folder, which is the high impact event, high impact. And then we click on apply filter. So you see now, all the red, all the yellow and orange are all gone. Now I have only red. Okay, so this is very important. This is something that you can also do. You can do it whether you're on your phone or you're on your laptop, whichever one, you can always do that, right? You can always do that, okay? Yeah, so now let's go back to the slide here. So we said before that these are the websites you go to, but Forest Factory is what we are paying more attention to, okay? Forest Factory is what we pay attention to. Okay, so yeah, let's just scroll here. Now, simple rules for using the calendar. When actual is greater than forecast, that is a buy for the currency. When actual data is actually higher than the forecast, that leads to a buy for the currency. That means there's an appreciation in that currency. There's an appreciation in that data for that country, for that economy. Therefore, the currency of that country will tend to buy, will tend to appreciate. So we'll be looking for buy opportunities when actual is greater than forecast. When actual is equal to forecast, that is still a buy, but not all the time. Not all the time, but in many cases is equal, especially when the forecast is much higher than the previous. When the forecast is higher than the previous, and actual comes out and is equal to forecast, that currency is going to buy. That currency is going to buy, because if forecast is less than previous and the actual matches the forecast, that doesn't mean it's going to buy. It might sell. But if forecast is higher than the previous and then actual matches that forecast, is going to be a buy. So when actual is less than forecast, is a sell for that currency. Because at that time, the data is telling you there's negative. That data is a negative data. And because it's a negative data, the currency will tend to depreciate for that period of time. It doesn't mean to depreciate for all time, for that period of time, because the data may be bad this month and may be good next month. It may be bad last month and this one comes out, it's very good. That's the way it is. So you see the way the market will react to it. The market reacts to it because for that time, the data is telling us to do something. The data is telling us as traders to do something. So we'll do something at that time. So these are some of the economic data, a few things about this economic data. Okay. So first is the CPI. CPI is Consumer Price Index. So it's basically a monthly data. It's released every month, and it measures the inflation within the economy. Inflation is the rise, the change in prices of goods and services. The change, especially a rise in goods and services. Now, of course, if there's a fall, if there's a fall in goods and services, that's what they call disinflation. Disinflation is also a type of inflation, right? So that one is whenever price of goods are rising, that's not very good for the economy. That's quite poor, So if prices appreciate a little bit within a certain streamlined band, a certain tiny band, that's healthy. So if you buy something $10 today, and you know that you buy something $100 today, and you know that in another 1 year, the price might increase by $2, which means you cannot buy it for $102. That's not a bad thing. That is good inflation. That's healthy inflation, because inflation will always be there. But the question is it healthy inflation or unhealthy inflation? Now imagine you buy something for $100 this year, and by the time you want to buy the same thing next year, you are not buying what you bought for $100, the exact same thing, you're not buying it for $120. That's inflation of 20%. That's crazy. So that's what central banks want to tackle whenever such things are happening, because that leads to instability in the system. Instability. When people know that the prices of goods will appreciate tomorrow or depreciate tomorrow, then it affects their behavior. It affects consumption. It affects everything. It affects businesses. It affects production. It affects consumption. It affects everything. You see? So this data is what we watch for this every month, and we watch for it for all kinds of currencies. We have it for AUD. We have it for the card economy, Canadian economy, Australian economy, Eurozone, US economy, all of that. All of them, we are always looking. They are always releasing data every month that has to do with CPI. So on this calendar, the Forest Factory calendar, this is where we go to monitor these events. We go to monitor these events on a daily, weekly, monthly basis. Then we have official bank rates. So this is another data that has to do with interest rates. This is interest rate data. Interest rate data. So whenever interest rate is high, the cost of borrowing will be high. So people tend to consume less. This is what central banks usually use to control inflation. When they think that the inflation that in the system is caused by too much money in the hands of people, because typically when there's too much money in the hands of people and they are chasing too few goods with it, there's a tendency for prices to rise. You see, that's what they call demand pull inflation. Demand pull inflation. So demand is so high and the price rises just because demand is high, not because the quality of goods increases, not because of any. So what central banks now do is that they either increase interest rates to make it more difficult for people to get money, businesses and individuals. So when it's more difficult for you to get money, let's see how you are going to spend a lot of money. That's the idea, right? So you have interest rate data for the UK, Great Britain economy. You have interest rate data for the US. It's called FOMC. You have for the AUD ROBA rate. You have NZD official cash rate, and so on and so forth. You on the economic calendar, you find this happen constantly. On the economic calendar, you find this happening constantly, right? So then you have GDP. GDP is another data that we're watching. It's called gross domestic product, right? So it's basically the amount of goods manufactured, consumed within an economy within a fixed period of time. It could be a month, it could be a quarter, it could be a year, So these GDP numbers are meant to be increasing. When the GDP numbers are increasing, it means that there's a positive in the economy. It means there's a positive in the economy, right? So that means the currency we appreciate. Once there's a positive in the economy, the tendency is that the currency appreciates. So now we are able to make a buy on that currency and make profit from that. But whenever the GDP comes down, that's what is called a contraction. Whenever the GDP reduces, so which means the amount of money in the system, the amount of goods bought and sold in the system has reduced, the value has reduced. So what does that tell us? There's a contraction. So once there's a contraction, it means that the economy is not doing so well. Then it means the currency would depreciate. So we can then enter sell trades in that opportunity, in that scenario, and we can still make money from that. That's why I said as traders, we don't really care. Though we care, but we don't really care. I hope we understand. All right. So now you have other fundamental events here. You have press releases by central bank heads. The central bank governor usually would whenever he makes a speech, there's a tendency that it will affect the currency because he's going to be saying what it is. He's an integral part of the government. Especially the economic part of the government. He's the head of the monetary authority in the country. So central bank governor is very important. So whenever he's talking, everybody's listening, including banks, businesses, investors, everybody's listening. So and once he says something that is not good or that is good for the economy, investors will act, the market will react. There's been times where the Federal Reserve chairman in the US, Federal Reserve is the Central Bank of America, there's been times where the Federal Reserve chairman is speaking and the market is just upside. The market is all over the place just because he made one speech. He made one speech and then the market is buying. He makes another speech, the market is selling. That's the way it is with central bank governors and speeches. So it's something we also need to keep our eyes on. Okay, so you have FOMC chairman speak, BOC governor speak, ROBA governor speak, Bank of Japan press conference, all of this. Whenever you see member speaks, BOJ, or whenever you see any central bank person, a key figure in the central bank, whenever you see a key figure in the central bank speaking, you want to pay attention to it. Now, sometimes it doesn't move the market, but when it does move the market, you also want to be sure that you're watching. Then you have some other data. You have PPI. PPI is Producer Price Index. That's something to watch too. You have Services PMI. You have Manufacturing PMI. All of these data points, you will see them. Once they are red, once they have red folder in them, it's a candidate to watch. Is a candidate to pay attention to. So that's the reason why when you go to the chart, you will see, oh, this one has red folder. This one doesn't have red folder. The one that has red folder, those are the ones we're watching. The one that doesn't have a red folder, those are the ones we are ignoring. In fact, we filter our chart to make sure only the ones with red folder show up eventually. All right? So Yeah, so you have crude oil inventories. This one is data that comes out every week. This one affects crude oil markets. Okay, so this will make the crude oil market either buy or sell, right? Then we have trade balance. Then we have non-farm, we have non-farm payroll and employment data. So this is another data that's very important. It measures the employment within a country within a fixed period of time, usually over the course of 1 month. Now, the non-farm payroll is the economic data from the United States. It comes up every first Friday of the month. Now, it's not only this employment data is not only for this particular employment data, non-farm payroll is for the USD, the US economy. But there are some other data too that from the Australian economy, from the UK, from the UK, from the Eurozone, from New Zealand, from Japan, all of that, Canada, they all have their own employment-based data as well, right? But the most popular one is the non-farm payroll for the US. Why? Because the US is the largest economy in the world, because the US dollar dominates the world in terms of currency usage and all of that. So we pay more attention to what the economic data, what the employment data for the US is saying. We pay a lot of attention to that, right? Okay, so this is where we put a close to this is what fundamental analysis is all about, right? So I know that some of us might have some questions, but we're going to create time to answer some questions. Let me stop this and see if you have a question so I can answer you. Okay.